All right. All you lovely ladies and perhaps gentlemen are tuning in on some of our local broadcasts here. I just wanted to welcome Nessa Meguire today. She's going to be talking to us about all sorts of wonderful tax saving strategies. So, as well as being a real estate investor, she is a CPA and a tax strategist focusing primarily on specific issues relating to buying, selling, and owning real property. She also works with families going through probate processes and other family financial transition events to provide guidance and resources. And finally, she's involved with buying, selling, and creative property notes secured by real estate. So those are some of her expertise, but she has lots more. And today she'll be teaching us on some of the big bucks, on some of the strategies for saving big bucks on our taxes. And considering the big percentage of your money that goes to taxes, this is something I hope you'll really tune into. So welcome, Nessa. As we start off, can you tell us a little bit about how you became so specialized in this area? Because I've always been taught, there's CPAs and there's tax strategists, and they are not the same thing, right? And maybe you can even talk to what the difference there is. Generally, the CPAs are preparing your taxes after the fact, and a tax strategist is putting together that strategy before tax season hits. So can you tell us a little bit how you got so specialized in this area that you're doing both and specific to real estate?
Sure. Well, I've been a CPA for many years. I lived in a small community in New Mexico, had a private accounting practice there. So I was I was really a generalist at that point, early on, right out of college. Worked primarily because I lived in a small community. We didn't have large industry. It was mostly small businesses and individuals. So I got a lot of experience working with small business owners, and thankfully I was in an area where I had high net worth clients too. So I was able to be involved with a lot of more sophisticated investing individuals and that kind of thing. Back in the early days of my career, we actually did 706s, which are state returns, which are kind of an extinct animal these days with the higher exemption amount. But so anyway, I say all that to say I was able to avail myself of a lot of different experiences in my practice, but it was all primarily tax, because tax was the thing that I just found the most interesting. Kind of interesting to, it's like putting together a puzzle to figure out the outcome you want, and then to go look for how you can structure that solution within the IRS guidelines to achieve that kind of thing. So it became kind of a game, I thought, in way. So anyway, that was my generalist experience. I did that for many years. I moved recently in the last 3 years to Cincinnati, Ohio, and through a variety of circumstances, I found myself in a position of gaining more not interest. I've always had interest in real estate, but expertise in real estate investing, and getting more heavily involved with investors and the issues that they face with their tax planning strategies, creative financing, all of those things that are specific to real estate investors, or more specific. And just found it interesting. I think after doing the same thing I'd been doing for so many years, it was nice to find something fresh and new, and that I could dig my teeth into, and really figure out how I could be of value to others in the real estate investing realm with my expertise, and learn more about their expertise and how they do what they do. So anyway, that's kind of it in a nutshell.
All right. Well, we're going to dig right in here. So you produced a list of your top 10 favorite tax strategies right now. So we're going to go through as many of these as we have time for. We won't maybe get through all of them. Some of these looked really, really interesting to me. So the first one you had listed, and I know you said they were in no particular order, but you said harvesting long-term capital gains in such a way that no capital gains tax is paid on the gains. I love not paying any tax on any gains. So, long-term gains is already taxed at a lower level than your regular income, but you're saying we can eliminate it altogether. So I'm wondering if this is alluding to like a 1031 exchange, or is there something else I haven't heard of here?
No, it has to do with the capital gains, long-term capital gains tax bracket rate, in the brackets. For example, in 2022, if a single individual had taxable income that was under 41,676, they paid zero. That's up to that bracket, up to that amount that I just mentioned, is the zero bracket for long-term capital gains rates. So just for simplicity, if you had no other income except long-term capital gains and your taxable income was under that amount, your tax would be zero. For married filing joint, that number is 83,000 and change. So the strategy becomes, for example, you have a married couple who has, say, $60,000 combined taxable income. Then you could take the extra 23,000, bringing you up to that 83,000 number. You could tack on another $23,000 of long-term capital gains, and pay no tax on that, on those capital gains. So, knowing your number, obviously you have to know what your number is, what your taxable income is, aside from any capital gains, any long-term capital gains. But knowing that number, then you have some ability to manipulate how much, if you have some ability to manipulate how much capital gains you can include in your income and not create any income tax from that. So, for example, if you could sell some investments, portfolio investments that would generate $23,000 in capital gains income, you could basically pay no tax on that by tacking it on. Or if you have an installment sale, if you've created a transaction where you have an installment sale and you can collect an amount each year of principal and interest, and part of that being capital gains, then you can also stretch that out over a period of time and just pull in, enough of the capital gains where you're not paying any tax on them. So
yeah. So right now, when we have a lot of creative financing going on because interest rates are so high, that might come into play, right? And then you could even use that in your negotiations with a potential seller.
Exactly.
So, hey, there's a benefit to you not taking everything at once. You'll get taxed really heavily. You could take the smaller amount and not pay any taxes on it.
Exactly.
And then I'll pay you another small amount next year. Not that small, but whatever it's called for.
Yeah, exactly.
Oh, I like that. Okay. Well,
and one other caveat to that is you just need to consider whether, do you have capital loss carryovers that you can apply against your capital gains, to decide, that might even give you more benefit. You might be able to shield more income with your loss carryovers first and then see what you have left.
Right. And I know we'll talk about depreciation, things like that as we get on, because yes, you could use that to offset a lot of that, right? So excuse me. So the second thing you had on here was utilizing an accountable reimbursement plan to maximize home office and vehicle expense reductions. So I have a home office. A lot of people do that these days, right? So many people have moved home. So tell us how this is different than just writing off a section of your house and a portion of your vehicles. What is this accountable?
Well, I really love this strategy. I've used this for years with my S Corp clients primarily, because it really, it's really most beneficial to S Corporation configurations where you have an employee. It can work too for LLCs, but as you probably are aware, there used to be an employee business expense deduction, right? That was an itemized deduction that you could take back in the days when people actually itemized. And it no longer exists. There is no such thing as the miscellaneous itemized deduction any longer. So employee business expenses, to the extent that somebody is an employee, and this would be like, the sale. You remember salespeople always had lots of expenses for taking people out to eat and traveling. And I had clients that could have upwards $20,000-$30,000 worth of employee business expenses that they put in with their as a miscellaneous itemized deduction and get it as an itemized deduction expense. But you can't do that anymore. So having an accountable plan means that you have drafted a document that spells all this out and gives you permission, under IRS rules, to have the company, the business that you're incurring the expenses for, reimburse the employee for those expenses. And so they're taken at the business level. The business is able to deduct them 100%. And the employee does not have to pick them up as income because they're just reimbursed expenses. So basically, you've shifted what used to be an only partly advantageous expense on the employee's return to the business return, where it's 100% deductible. So that's a big piece of it. Now you can also reimburse the employee for depreciation on the vehicle. So the vehicle is in the name. Typically, the vehicle should be in the name of an employee, or should belong to the employee. And I won't get into the reasons for that, but that's a better scenario. So you can have the company then reimburse the employee for all the auto expenses, including depreciation, which they don't have to pay tax on. So that's a benefit. The other thing that I've found beneficial as a result of the change in the standard deduction is a lot of people aren't being able to take advantage of their mortgage interest deduction any longer, or their property tax deduction. This way, you can carve out the home office portion, be reimbursed by the company for that portion, and then if the rest of the mortgage interest is non-deductible by virtue of you having taking the standard deduction and not getting a benefit of it, you now haven't lost the benefit of the entire deduction. You've shifted some of it to where it can be utilized, and I think that's a big plus as well.
That's really nice. That's really nice. I love that. Yeah, anything that can help retain employees these days, right? As employee costs go up. Yeah, those are great added benefits. So the next thing you've got on here, and this one intrigued me, it says using backdoor Roth IRA and mega Roth 401ks to maximize contributions. And I'm going to you've got a couple of things about IRAs. So another one you've got on here is contributing to traditional IRAs and then converting to Roth at a discount. And I can't wait to hear about that because I just did this process and I'm wondering if I left some money on the table here. And then the last one you have is using self-directed Roth retirement account for alternative investing. So I'm assuming we're talking about an alternative to the stock market there. So I think we should start with explaining to folks the difference between a traditional IRA and a Roth IRA. So the rest of this will then make sense. So can you start us off there?
Mm-hmm. So traditional IRAs, as well as traditional other retirement accounts, are traditional because you can get a deduction for making contributions to them, a deduction against your taxable income. A Roth IRA, you get no deduction when you put the money in, but you also never pay tax on anything coming out. So any appreciation that takes place after you put that money into the Roth account becomes completely tax exempt, tax free. So it can provide amazing results if you can grow it. The trick then is to be able to grow the investment in the Roth in a substantial way and bypass the tax on it entirely. So for real estate investments, across the board, you pretty much are going to hear everybody suggesting that Roth is the way to go for those, because just to give you a little snippet, because you can do and this is kind of jumping around, but because the self-directed IRAs allow you alternative investments, meaning things like real estate and crypto and syndications and, various things that you can't otherwise do within a traditional IRA account. You have the ability to do something unique with that investment that might result in a much larger return on investment than your average stock portfolio. And as being a real
Oh
estate
yeah.
investor, you're aware of that. So, for example, you do some kind of a real estate transaction where you put in very little and you get a lot back, and it's all in your Roth. Well, now you've taken, a $5,000 Roth IRA, and you may have just grown it to $25,000 over the course of a year, but that's all tax exempt now because it's in the Roth. So
yeah, the way I always heard it played is if you're planning on making less money in the future, not doing well in your IRA investments, then go with the traditional. If you want to grow it and make it more profitable, then you don't want to be taxed on that. You should be in a Roth. So,
yeah, and I think I think this still is valid. I think the idea that the younger you are, the more valuable a Roth is to you makes sense because you have more time to grow it.
yeah.
But I also think with the think outside the box kind of investing that real estate investors are sometimes involved in, that a Roth can make sense at any age. So
Yeah,
yeah.
I mean, we're starting one for the kids right now. And
Yeah.
we've got this complicated structure. We're all kind of investing together under an LLC in our retirement with the Roth and the 401ks and everything all blended together. We won't get into that. That's advanced stuff. But
Well,
start them early. Start them early.
IRAs and the health savings accounts, and they're they're you can take all of those. You guys be in partnership together. All of those various entities can partner up and do something. And yeah, I mean the opportunities are endless.
Yeah, once it's self-directed, your hands are untied and you can really grow that stuff really quickly. So, okay, so what is this backdoor Roth IRA and mega Roth 401ks and maximizing contributions? What's that all about?
Well, because that you are often limited to the amount that you can contribute to IRAs and sometimes 401ks, less 401ks are more generous. You can get more in. So basically, it allows you to stack contributions of all kinds: 401ks, IRAs, conversions, non-deductible contributions, after-tax contributions. You can get a lot more money put into those retirement accounts under the traditional way, and take a deduction for it, and then you can turn around and convert them to Roth. So you may pay some, obviously you can potentially pay some tax on it, but that's also where we get into the other concept to discuss about taking about discounting the conversion. But so the backdoor, I mean, I'm getting off track here. Let me get back on. So the backdoor Roth IRA simply allows you to put more money in than you might not otherwise get to put in due to income restrictions. But you can take all of those pieces from whatever source you can grab them and put them in to those accounts, and then simply do a conversion into Roth. So everything becomes, it is that super vehicle, the Roth, where you can do so many things with it and create a lot of tax exempt income.
Yeah. So you mentioned doing a lot of things with it. Nikki just commented that a few of her private lenders have used money from their self-directed IRAs. And that's something that not a lot of people know you can do, but you can do private lending through there.
Exactly.
And you're not paying taxes on the income that those loans are then producing.
Exactly. Yeah, that's
one of many things you can do in those accounts.
Yeah. No, private lending is a really great way to use your Roth IRA.
Yeah. And it's not even difficult through there. You can get at that money pretty quickly with those accounts. So this one I'm really curious about because I said I just did this. So I had traditional IRAs. My husband and I together, I think we had like 6 different accounts. So we were consolidating everything, pulling it all together into self-directed 401k kind of situation, or solo 401k. Anyway, we took our traditional IRAs, we converted them to Roth. So I took the tax hit there, right?
Right.
Because I got to pay the taxes before they go into the Roth. But then we bought a property at that same time, did the bonus depreciation, cost segregation, all of that. So we wrote off all those taxes. And then we put them into the Roth. So that worked out well. But now you're saying you could do a conversion and get a Roth at a discount. So how do you get this discount? What is this magic discount I didn't know about and probably left money on the table?
Well, you make a deduction, you make a contribution into an IRA account and take advantage of the deduction. So that would be cash. But then once the cash is in that retirement account, you can purchase property with it, whether it's real estate. Well, typically it won't just be real estate that you own 100%. It'll typically be some kind of an investment where there's a justification to apply a lack of marketability or a minority discount to that property. So, for example, this is kind of pulling from estate tax law. When you do an estate income, not estate income tax return, but an estate return where there was estate taxes paid, which I mentioned, that's kind of a that's not something people see anymore much because the exemption amount is so large now. But you would take, say, a partnership interest, and when you were valuing what that partnership interest was for estate tax purposes, you could apply a discount because it lacked marketability. They might have only had, they have something in the partnership agreement that says you can't, your hands are tied as far as getting rid. Any partner can't just go out and sell his share in the partnership to anybody they want. They have to have permission from the other partners, or whatever the structure is. So their hands are tied, basically.
So you mean like in a syndication, if you're an LP investor, limited partner, and you want to sell that share, it's not something you can go advertise. It would have to be to a friend, and the general partners have to agree.
Yes,
You're saying that, so there's limited marketability, and so for that you can get a discount in your Roth.
That's right, exactly. Or a minority discount. If you only own, a minor share in the entity, then obviously you don't have as much control as somebody else does. So they have these discounts that can be applied. I mean, it involves getting somebody involved who knows how to determine what those discounts are. It starts with an appraisal, typically, of the asset, and then the person with the expertise decides what a appropriate discount would be for that asset. But done rightly, done correctly, and it might just even be an asset that's jointly held. It might not have to be within an entity necessarily. It just depends on what kind of asset it is and what the terms what the terms of disposing of it would be, and that kind of thing. So technically you can potentially, you could end up with a 50% marketability discount. So you've taken,
wow, that's huge.
That you invested $100,000 in, like you mentioned, syndicate. That's a good example, into a syndicate or into a LLC. And because of these extenuating circumstances, it's really only worth $50,000. So that becomes, that's the amount then, that you're having to pay tax on for the conversion is the 50.
So it doesn't really matter what that value is going to be when you exit whatever that deal is. So if you're going to be tripling your money, that has no effect on it. You could still potentially take a 50% discount at the beginning because you're kind of locked in.
That's right. Yeah, you're looking at the beginning, like, what is this asset worth right now? Because that's what you're paying the tax on. That's what you pay tax on. Anytime you're doing a conversion, you're paying tax on the value of that account at the time of conversion. So
interesting. Okay, I'm gonna have to look into that one because I do a lot of LP investing. I'm guessing a lot of people watching this are doing the same thing. So this is an interesting one. You say take advantage of the no wash sale rules of crypto. So I know a lot of people lost some significant money in crypto. I know I put some money in. I knew it was not an investment. I knew it was a speculation. So I only put in what I was willing to lose, and that's good because I lost 75% of it. Um, hey, sometimes you got to roll the dice. But so, what is this no wash sale rules
Well,
on crypto?
the wash sale rule is typically applied to securities, and it says that if you are to sell a security and immediately buy it back, or buy it back before 30 days has passed, the IRS disallows you taking a loss on the initial sale,
Okay.
because they say you're basically just, you're just doing it to try to avoid taxes, and you still end up with the identical investment after all is said and done. And so they have those rules in place where you have to wait 30 days before you could actually repurchase that asset, or you have to suspend the losses on those. Crypto, you would think, would fall into that same category, but it doesn't. For whatever reason, crypto is at this present time exempt from the wash sale rules. Now, there's been talk about applying them to crypto, but it hasn't happened yet.
Well, because in the United States, they did deem crypto to be a security. I know there's a lot of back and forth on that for a while. But what you're saying right now, it's legal for me to sell my crypto today, take that 75% loss, write that off on my taxes, and then tomorrow go buy them back and pray and hope that they go back up and become worth something.
Yeah,
And I still get
that is technically that is legal right now. But as a caveat, the IRS has a set of rules, economic substance doctrine, which basically, says what's the purpose of you doing what you're doing, and if it's abusive, they have the right, they've given themselves the right to go in and say, no, we're not going to allow that transaction. Now, if you just do one sale here and there, you're not going to get into trouble. If you were doing it excessively, that's where potentially you might want to think twice about it. Or if it was a large, if you were talking, huge amounts of money. So, but yeah, technically,
Okay.
it's fine. I do know, they're doing with crypto what they did with foreign bank accounts a few years ago. They really ramped up monitoring people that had foreign bank accounts, and they started requiring everybody to answer that question on the 1040 about whether they had any, were they required to file the appropriate return, informational returns. Starting last year, for the 2021 filing tax return year, they had a question about crypto. Do you have crypto transactions? So you can figure that there's more coming down the pike, where they're going to be scrutinizing those transactions more closely and making sure that that they think they're being reported correctly.
Yeah, for all those people who got into crypto thinking I can do all this without government involvement, those days are over, I guess.
That's right.
So the next two things you have on here are two of my favorite things in the world. So cost segregation and bonus depreciation. So we do this on all our big investments. We even do it on some of our smaller ones because the bonus is so amazing. So talk to us a little bit about that.
Well, bonus depreciation has been around for a fairly long time, as you know, at this point. It seemed like every year was like, oh, just this year, oh, just next year. Yeah. No. So we still have 100% bonus depreciation through 2022, the year that we're currently getting ready to do returns for. And it drops 20% each subsequent year, at least right now with the current legislation. Bonus depreciation is simply that you can effectively write off almost, depending on how much you have in assets that you purchased during the current year, you could potentially be writing off 100% of those assets completely in 1 year, depending on the limits, which are pretty high. It's been, we had 179, we had the 179 deduction forever before we had bonus depreciation, and that was very similar to the bonus depreciation. We could elect to expense a certain amount of assets that otherwise would have to be depreciated. But you had to have net income to do that. That was a big difference between the bonus depreciation and 179. For example, had if you had a Schedule C, unincorporated business on your return, and you had, without regards to the 179 deduction, you had net income of $50,000, you would be limited to that 50,000. You couldn't take more than $50,000 of 179 depreciation, to zero it out. The bonus depreciation doesn't have that limitation, so you can actually be creating losses with it.
Amazing. And you can push it to future years as well.
And yeah,
right?
and
It doesn't go away.
absolutely. Yeah.
If you don't have enough for this year to write off, you can write off next year. It stays with you forever until you've used it.
Right.
Yeah.
And you should always consider your particular situation. Will electing bonus depreciation be worth it to you if it's going to be suspended because you have a passive, because it's part of a passive loss? Then maybe it doesn't make sense to do it if it's just.
I think we should back up and maybe talk about what depreciation is. Some folks may not understand what depreciation is, and therefore not what bonus depreciation is. But basically, it's a paper loss of your real estate, right? So the IRS is saying, and check me if I'm right here. I have this apartment complex, for example, this apartment building. They're saying that's going to last 27 and a half years, and after that, it's worthless, which we of course know isn't true. So we're taking 27 and a half. We're dividing the value by 27 and a half and taking that every year. But with bonus depreciation, we're accelerating a lot of that. And we're counting the things that are in it, like doorknobs and cabinets and appliances and air conditions and all of those things. That's why we do this cost segregation to get a feel for how much of those things are. And we're going to bonus all that out right at the very beginning instead of waiting 27 and a half years. Did I explain that?
You did. The one thing I would add to that is, with respect to bonus depreciation, the useful life of the asset has to be 20 years or less.
Yeah.
So that does eliminate the real property that has to fall into that 27 and a half or 39 year category, depending on.
And it doesn't apply to the land.
And it doesn't apply now. No depreciation applies to land. Land is just, it has the same basis throughout as long as you own it. But yeah, you're right. I mean, basically it's a way to take the cost of an asset that has a longer useful life than 1 year, and take a portion of that as an expense against income every year, so that it's kind of equitable that way, presumably, because the rental income you're getting rental income as a result of having that asset. So that it's a cost of doing business, so to speak.
Yeah. No, I love taking all the depreciation you can, and that bonus. Yeah, like you said, this coming year it's 80%. So whenever somebody is investing, especially as an LP, that's a good question to ask the syndicator: is are you doing a cost segregation study so that I can get the 80% bonus depreciation? Because that's a nice kicker to the income the property is going to be generating, and so you're also going to get those tax benefits. Because even as a limited partner, that comes through to your taxes. You are an owner in that property. So a lot of people don't realize that. They think if they're just investing that they're not a true owner and they don't get these tax benefits, but they do, right?
Yeah. And that's obviously that's one of the biggest benefits of owning real estate, is having that depreciation deduction. Yeah.
Okay. So this next one, I've never even heard of. Section 121. The use of Section 121 to exclude the $250,000, $500,000 gain. I'm guessing that's single versus married filing jointly gain. So what is this Section 121, and why have I never
Well, I think you have heard of it. You probably just haven't heard of it called 121 because that's kind of technical. But it's simply the personal home exclusion, that's been in existence forever. There was a time, and I'm sure it was probably before your time, before you were paying taxes, I'm guessing, when they had a different set of rules about owning your personal residence. You had to reinvest the money in a new home to get to exclude it. And then these rules took the place of those old rules and said if you've lived and owned your house 2 out of 5 years,
Okay.
let me rephrase that, lived in your home as your personal residence and owned it, 2 out of 5 years, then you can exclude, if you're single, you can exclude $250,000 of the gain from income, and it's just tax exempt. You're never going to pay tax on it. And if you're married filing joint, you can exclude up to $500,000 worth of gain.
So this is if you are selling your home after you've lived in it, but you could potentially. So I've lived in it 2 years, then I rent it out for 3 years. So it's 2 years within a 5-year block. Then I sell it after that. So I've earned rental income off that house. I've lived in it myself. And now I sell it, and I can still exclude, if I'm married, up to $500,000.
You can. Now you'll have to consider the depreciation that you took while you were renting it. That would be subject to recapture.
So a little bit of depreciation.
A little bit of that, yeah. Okay. But then you could repeat. So for example, if somebody was willing to up and move every 2 years to a new personal residence and start the clock running again, then they could potentially every 2 years, if they were experiencing significant appreciation of the house, they could sell it. Now, there's another kind of twist to this, which is not for the faint of heart, but you could use a creative financing structure to sell your house with an option to purchase it back. And if it's done correctly, you don't have to move, but you've sold your house and then you can repurchase it. So
wow.
That's very,
that just blew my mind.
avant-garde kind of thing. But but it's done, and it's done by people who know what they're doing, and has been done by certain people that I know that are really savvy real estate investors, multiple times. So, yeah.
And this is something I didn't know about for a long time. I do know about it now. I did not know it was called the Section 121. But every time my husband and I have moved, we have rented out our home after that. And yeah, so we probably should have sold right at that 5-year mark, or maybe move back in for a little bit and then rented it out again. But yeah, I didn't know about this until we had passed that 5-year mark. But I will from now on. Should I ever want to go through the headache of moving again?
Right. That's what's so great about the idea of selling it and having an option to buy it back, because you can live in it and rent it if you can become the renter for the person that you sold it to, and
that's
then
amazing.
You never leave, but you still get the
still get to
done that. Yeah.
Not have to recoup those funds. So that's great. Okay, so the last one here, and we are a little bit over time, but I can't let you go without asking you this one. So deferring and or eliminating capital gains through the use of opportunity zone funds. So I hear a bunch about opportunity zone funds, and I have read up on it, and I gotta say it's still Greek to me. So enlighten us, please.
Right. Well, as we all know, the 1031 exchange was kind of the boilerplate. How are you not going to pay tax on your the sale of your property? Mm-hmm. But there was some downfalls to that. It was just a deferred tax. It wasn't an eliminated tax, and
unless you deferred until you die.
Yeah, well, defer till you sell, either till you die or till you sell the property, right? Yeah, if you die, then it is exempt.
Well, but I mean, your heirs don't inherit there's no tax burden. It goes away when you pass away. So the idea is you just keep exchanging properties, increase the value, never pay tax. One day you pass away, you leave it to your heirs. They don't have to pay the tax. It resets to base.
Right. Yeah. Because you get a stepped up basis at that point.
Right.
However, aside from keeping it till you die, at some point down the pike, you're going to pay the piper when you do sell that property, because it'll have a very low basis, and then you'll have to pay the tax on it. The opportunity zone funds are specific funds that are organized to invest in certain areas that the IRS allows. The purpose of it is to gentrify areas in a community, and provide opportunity for there to be investment into those into the real estate structures in those areas. So if you have a large capital gain from a transaction, you can defer the tax on that by investing into these funds. It'll be deferred until you cash out, unless you wait for 10 years to exit the investment, in which case it's tax free. So it's a way of deferring, which would be like a 1031 exchange, but you can also end up making it completely tax exempt, and you don't have to wait till you die to do it.
Now it's a fund. So what does that mean?
So there are, I mean, anybody could do it on their own, but it would be very cumbersome and expensive, because there's a lot of hoops that you have to, you have to have specialized knowledge. There's a lot of hoops regulatory hoops that you have to jump through, and that kind of thing. So there are funds that are created for this specific purpose. As I mentioned, I'm in Cincinnati, Ohio, and there is an organization. There's a fund in Columbus. A couple of brothers who were in construction forever in Columbus, and decided to do this because they wanted to invest in their community. And so they've done, they've created this fund so others can invest in it. I mean, it's a fund like, in the, I don't know if it would be like syndication. You probably can speak to this more than I can, but
it's passive. It's passive. You're not having to go build a house there.
Right. They're doing, they're managing it for you. You're investing in the fund. They're investing in projects. You're receiving you get pass through depreciation from the fund that can offset other taxable income. What you have to invest it within 100, you have to reinvest within when you have a gain, when you have the original capital gain that you're trying to shield, you have to reinvest within 180 days. From the date,
similar to 1031 exchange.
Yeah, exactly.
Ticking time clock. Yeah. Mm-hmm.
And you can, and you only the portion of the investment that's attributable to the capital gain is eligible for exemption from tax. So, for example, if you got $500,000 from the sale of a property, but your basis in that was $200,000, you could invest $300 and have that exempt. That would be your gain, exempt from tax. You could invest the whole $500 if you want, but you aren't going to get the same tax benefit on the whole amount.
Got it. And then as long as you keep it in there for 10 years, there will never be taxes that follow you on it. You're just free and clear.
And
can you take a 1031 exchange and exchange it into one of these funds?
You could, but it would kind of, I guess you could. You're kind of doubled. I mean, you're not going to have as much benefit of it because you've already deferred the gain. So now you don't have that much gain to invest in there.
Oh, that's true. Yeah.
So yeah,
I was just trying to think of how you get out of those 1031 exchange if you want to cash it out.
Yeah. So. Now, I mean, if you sell a 1030, if you sell a property that you previously did a 1031 exchange on, and it had an extremely low basis, then you would have a lot of gain, and you'd have the maximum amount of deferral or exemption.
Okay. So you could sell the 1031 exchange, put it into an opportunity zone fund, the gains portion, and that can then eliminate those taxes that you would otherwise have had to pay. So you're not exchanging into it, you're taking it, and then you're putting it back in. Oh, I like that. Right. I get that question a lot. People they've been 1031 exchanging, they've built up a lot of that tax come due one day, and they want to know how to get out of it because they're not wishing to continue to exchange until they die.
I have a client in California who, they did a 1031 exchange on some apartments, like back in the 60s or the 70s or something. And they just sold it. And you can only imagine, the basis in that is like nil. And so they would be a perfect candidate for that. And there's one other thing I want to mention that excites me about this is, and I don't know that Ohio is the only state that does this. I'm suspecting there might be some other states, but in Ohio, the state of Ohio gives a state income tax credit equal to 10% of your investment.
And the opportunities
so that benefits you state-wise. And if you can't use that credit because you're not an Ohio resident, you can sell that credit to somebody else who can use it.
Oh, wow. Wow, that's
powerful. Now you have, you invested $100,000. Well, now you have another $10,000 of some asset that you can sell and benefit from. So
Nice, nice. All right, well, we got to wrap it up there, unfortunately, because I could talk to you about this all day long. But if people want to reach out to you, learn more, talk to you more specifically about something like this, how would they reach you?
my email is Tracy, TRACY, at Tracy Meguire, TRACYMEGUIRE.com.
Okay.
My website is thrivewealthpros.com. And either of those will lead you to me.
Okay, very well. Well, thank you so much for being here, and thank you everybody for listening. And we will continue to monitor for questions and such in the recordings. So if you have additional questions, pop them in there, and we'll try to get them answered for you.
Thank you, Maria.
You're very welcome. Thank you, everybody. Have a great day.